right, so our final presentation before the break, Taralee Muhli with Transition 360 is going to talk about building for the exit in your small business and the ultimate end of the small business phase for many. So Taralee, thank you very much. Please welcome her to the stage.
Thank you. Wonderful. Well, I'm just going to dive in because we don't have much time. Joe asked me to take a probably 10-hour presentation and jam it into 15 minutes. So hold on, fasten your seatbelts. But a round of applause, please, for these restaurant owners. This and truck and and brewery. That is probably one of the most difficult jobs on this planet. And being a business broker and selling businesses. Restaurants are incredibly difficult. And who loves Joe's energy? Thank you. Yeah, so thank you, Joe. Yeah. All right, with that, first, I think for the business owners in the room, no matter what stage you're in, you got to start with the end in mind, just like when you want to retire and you want to go off and do something else. What's your plan to get there? Same with your business. I know it's hard. You're faced with so many different things are coming at you. 50 different things are coming at you. You're like, oh, now I got to focus on, exiting my business. But you must. It's something that you must think about because there are different ways to exit your business. One that I tell most of my business owners who are probably not ready to sell, or they think they are, but they're really not ready. Is you can die at your desk. Because that's the way you're only probably going to sell. But you can stay at, or you don't have any hobbies. We don't have anything outside that you can do to, business was your life. So what do you do when you sell your business? So ways to exit your business, you sell to an outside third party. So either an individual, a strategic buyer, private equity, search fund, or family office. I'm not going to go into what all those different types of buyers are, but there's a lot of different buyers out there, and that's always a question that I get from people is, who are my buyers? And it really depends upon your business. It really requires, you can go on to Google and be like, who would buy, my business, right? Well, it's not that easy. Google is not the right answer for your business. I'm sorry, but it's not, especially when valuing your business. Google is not going to give you that right answer. You can sell to an internal employee, or if you have a business partner, you can sell to your partner. You can transfer to your children. There's all sorts of estate stuff that go along with that, and a lot of tax planning. I do valuations for clients all the time, and I say, hey, before we do anything, you're going to take this number that I gave to you, which is generally half what they think their business is worth. Say, take this number to your CPA, find out what your tax bill is going to be, because then you're going to give that to your financial planner, and you're going to say, well, what? I thought my business was worth $10 million, but it's actually only really worth $5 million. And now you have to give 50% to the government. And it's like, oh, your whole retirement trajectory plan just changed. So tax planning, there's a lot to that. You can wind it down, you can shut your doors. That's one way to exit your business. Transfer using estate planning trusts. You can die at your desk or on your way to work. You got to plan around that, or you can sell to an ESOP. A lot of people, they want to sell to employee-sponsored programs. I'll tell you right now, it is very expensive, and those are generally reserved for, or not reserved, but make the most sense for if revenues well north of 50 million in revenue. It's generally $200,000-$300,000 a year just to maintain that ESOP. So if you want to sell to your employees, you can do it without an ESOP, much cheaper. So this is what not to do.
This looks expensive.
This is some new bedding.
David, didn't I just tell you to save your money?
Yeah, I am testing this out for the stores, so work is paying for it.
Work is paying for your bedding?
I was gonna leave, but now I don't want to. So.
What is that? Is that a new lamp?
Yeah, I'm thinking of bringing homeware into the store, so that's a write-off.
That's a write-off?
Yeah.
Do you even know what a write-off is?
Yeah, it's when you buy something for your business and the government pays you back for it.
Oh, and who pays for it?
Nobody. You write it off.
Who writes it off?
I don't know, the write-off people. Why are we having this conversation?
So if I need booze to get through my day, I can just write that off?
That's a stretch.
But the skincare products you got this morning, those are a write-off.
What skincare products? You purchased skincare products?
Okay. I am the face of the company. If I have acne, what does that say about the legitimacy of the store?
That's not a write-off. That's not a write-off. This? Not a write-off.
Oh, well, the betting's non-refundable, so.
David, a write-off is a business expense used to reduce your taxable income.
Okay, well then, why isn't it called a tax write-off?
It is! It is! You can't just buy things for yourself and write them off.
Well, then I'll return some things. There's not enough space in here for the massage chair anyway.
I should get back to work, just in case any more of your packages arrive.
I will tell you that your business value is what you drop to the bottom line, okay? And when I go back and I recast your financial statement and all your expenses that you had in there, whether they were legitimate or not, I can add those back. But the bankers in the room are gonna say, no, you can't, right? All of that stuff that you've been burying in your business will dictate maybe who your buyer might be. So let's say you want to sell right now, you've been driving all of your personal expenses through the business, I'm gonna add that back, but guess what? The bank is not going to finance that, okay? Because they can't show the cash flow. You can't have your cake and eat it too, okay? So if you can't show as much money to the bottom line as possible, I'm trying to get you 3, 4, 5 times for every dollar value, and you're trying to save 30 cents for every dollar just to avoid taxes, okay? Just put as much money to the bottom line as possible, all right? As soon as possible, all right? And then that way, you don't have to play bank for your buyer, because then the buyer can go to the bank and get a loan and give you the pile of cash, okay? So that's one way to dictate who your buyer is going to be. But only the P&L is a recast. And what I meant by recast is I start with net income, and then I add back stuff or take it away. If you're not paying yourself a reasonable salary and you think somebody's going to live off $40,000 a year in Seattle, I'm going to have to adjust for that. They need to probably, depending upon the business, 125, 150, 175, 200,000. I'm going to take that off the table. Okay, that's going to come off income. Okay, so I adjust the profit and loss statement, and it starts with net income. If anybody tells you that your company is worth a multiple of your revenue, they're wrong. Okay, it's just a barometer. Okay, but if you're not making any money, who's going to buy your business? How are they going to repay the loan, you, the seller, or a bank loan if there's no income? They'll just wait for you to go out of business, and then they'll get your customers and your equipment, but they'll just wait you out. Okay? The balance sheet, I'm not going to go into a lot of detail. That's not used. I will say one thing. If you're taking distributions instead of a W-2 salary, when the buyer buys your business, they don't have a fat bank account where you've been shoving money into your bank account for the last 20 years and taking a distribution as your income that you needed for that. So I'm not going to count distributions as part of the income that a new owner is going to make, because you're taking all the cash. The seller's taking all the cash with them when they sell. So they have to have a reasonable living wage, and they have to have a salary. And that is a W-2 on the P&L. Okay. So this is an eye chart test. Any optometrists in the room, raise your hand so that people can reach out to you. But this is really, you can't wake up in the morning and decide to turn the sign on your door that says, hey, guess what, I'm for sale. Okay, generally the process takes, for me personally, 2 to 3 years just to get ready to go to market, okay? And then when we're in market, by the time that you actually sign on the dotted line is 18 months. And then you have to stay with the company for a period of time, depending upon what that might be, from 3 months to 3 years. So all of a sudden, this just turned into 10 years, 5 years, whatever your time. So if you wake up one morning, you're like, you know what, I'm going to sell. I'm going to be a bearer of bad news and be like, well, guess what? You're going to have to work at this for another 5 years. And it's not easy. It's just not easy. So these are some of the things you got to define your objective. Either it's a function of time or money. How much money do you need to retire, or what's your time frame? Do you want to retire by a certain age or have a certain amount of money in the bank, or both? So you got to define what that is. You need to get your business valued. I will tell you, the past 50 valuations that I have performed over the past 5 years, I think twice, somebody said, is it really that worth that much? Oh, I didn't realize that. Usually I brought one grown man to tears. And that's not a reflection of my inability to value, it's reality. Okay, your business is probably not worth what you think that it is. And so you have to plan for that. So how do you make it more valuable? And you cannot turn this Titanic around overnight. Okay, especially if you've got to be dropping money to the bottom line. And money just doesn't grow on trees. Got to have your financial plan. You've got to get your legal house in order. You got to get your taxes in order. You got to package the business for sale. We got to get the bank involved. We got to think about your post-sale and who's on your team. Okay, if you refuse to have a team of people help you through this process, you will fail. I'm sorry, but you're probably not going to get as much out of the business as you had hoped, whether it's the sales price or what you put in your pocket, okay? Because there's taxes, and then there's the value of your business and being able to package that and relay information to a buyer about your business and get them to buy in, because they don't have a nice little podium, that's about 4 feet tall, and they're just looking at black and white. They're just looking at numbers, but other than that, anyway, it takes a lot to get your business packaged and prepared. And then here's another eye chart, very technical, as Joe said, but this is the process. The process to sell is not easy. Business owners who said I had no idea what it takes. Has anybody ever sold a business in this room? Yeah, okay, 1, 2, 3, 4. It was probably a difficult process for the most part. Some of them can be pretty easy, but for the most part, and I'm not here to scare you. I'm just here to say, hey, this is truth and reality. That it is a process, and your team is probably hopefully me. I'm valuing your business. I'm going to sell it for you. I work with sellers, not with buyers. I'm an intermediary, so I'm going to help the buyer and get to the finish line. But my client is the seller of the business. There's not a lot of buyer representation that's out there. Also on your team is going to be a CPA. Not your divorce attorney from the 80s, okay? M&A attorney, not a business attorney, possibly, but a merger and acquisition attorney who knows language that goes into a contract to protect both buyers and sellers in the transaction. Okay? First time in our 40-year career, we had a deal unravel a month after it was purchased, and their attorney bill was $1.5 million to unwind it, and they sold the business for $3.5 million. So it was a nightmare. Anyway. So top 10 things that business owners get wrong when they want to sell their business is they personally overvalue the business. And so getting a valuation from accredited valuator to say, hey, this is truly what your business is worth, so that you can make plans. That's paramount. Can't really start without knowing where you can't really get to the end without knowing where you're starting. You don't prepare. You don't have a deal team. Okay? You try to time the peak. Well, you know what? I know that my business is going to. I just know that next year it's going to be better, and my revenues are going to go up, and this is going to happen, and this is going to happen, and then all the stars are going to align, and it's like having a child. It's like there's never a perfect time, right? You can't just figure it out perfectly. And so you try to figure out your peak and, oh, guess what? We have a pandemic or we have interest rates that go up and up and up, right? Guess what my client values have been doing when interest rates go up? Values go down. And they're like, oh. And I have 6 companies right now like, that I can list off the top of my head that just said, I can't afford to sell. My value went way down, taxes went up, I can't afford to sell. So they have to hold on. Underestimating the emotional impact, that's huge. Rushing the process, again, we talked on that. Over-reliance on a single buyer. I have this buyer. Okay, they're perfect. No, they're not. They're probably not. But anyway. Failing to address issues. I have a client who had a general manager who he would not fire because he's like, I can't do the work. I need that general manager in there, but he's stealing money from me. He's super toxic with the employees, and he's not doing his job. I always strike 1, strike 2, but he's here. He's butts in the seat. He's somebody that's gonna, so we get an offer from a company, but we can't tell this general manager that we're selling this business, the $16 million business, to a Canadian buyer, because you can't tell the general manager anything because you can't trust them. Buyers are like, oh, that's a little uncomfortable. Well, okay, we get it, we'll continue to move forward. Well, guess what my client decides to do in the middle? Due diligence is open kimono to the buyer, okay? You signed a letter of intent, you're under contract, show us everything, to the buyer. He fires his general manager in the middle of due diligence. We had a phone conversation, Canadian buyer, 15-minute conversation. 2 minutes later, I got a call from the buyer and said, we're done. And so he did not address this issue that he has a super toxic general manager that should have been fired years ago. Okay. That's just one example. I could stand up here for days and tell you stories. But if you don't address it and you put your head in the sand, I guarantee you that your deal will fall apart. 1 year does not make a trend, okay? We all had, you know what, I don't have time to go into this one. I just don't. Okay, underestimating the time that it takes to sell. I just addressed that, and neglecting effective marketing of your business. Effective is the key word. Okay, when I take a client to market, we've got a 15 to 20 page document that tells a buyer everything that they would possibly want to know, and guess what? It doesn't tell them who the company is. But it gives them all the meat on the bone, but you don't have to tell them who the company is, right? So how do business owners go out there and say, hey, I'm for sale, but I'm not going to tell you who I am? So anyway, no. So exit big. Culture is a big one. Understanding most of business owners started the business in their garage, and they created a legacy. So a culture is really important. That comes down to who your buyer is going to be as well. Just real quick, what we do a business valuation. Well, first of all, I determine if there is a valuation to be done, and then I'll do the valuation. Then we need to get to, if it's not a number that you like, how do we get there? Okay. Then we plan your exit, and then I sell the company. Questions?
Teresa, can you go back to that? Oh, yeah. So as you think of your questions for Taralee, I wanted to put this into some context a little bit. Most business owners are in what generation? Anybody in here? Gray, baby boomers. Most American small businesses are going to change hands or not in the next 5 years. $14 trillion worth of assets. What do you think happens to most small businesses, folks? Somebody different answer that question. What happens to most small businesses? They close. Loss of jobs, loss of local economic impact, downtown vibrancy. This is why this is a really important topic. So Taralee's job is to help small business owners realize a potential economic future and keep microeconomies running. So with that said, Taralee's covered a lot of ground. A question?
Well, to your point, is that 1 in 4 businesses actually successfully sell. So if they go to market, hey, I'm for sale, 25% of them, the other 75% have to shut their doors. And my personal success rate is 93%. Granted, I'm taking what I know can sell. I'm not taking anything and everything and putting it on a wall. But, you know, it's that conversation that has to happen, you know, that, hey, am I sellable? So, questions?
Okay, Larry.
So you go through all of this to prepare to sell, you get involved with a company to buy, there's a fair amount of work and labor and hours and documentation. How do you protect yourself against that $400,000-$500,000 bill to do the due diligence and stuff like that?
The $400,000 or $500,000 bill from your attorney?
Well, attorneys, people to accumulate the information that the buying company wants, to answer all the questions, you know, there's a bunch of stuff in there, and it all costs money, either time or paying a lawyer or paying a CPA.
Sure.
Or all the above.
Did everybody hear the question? I didn't hear the response.
It's a tricky question to recap, but the question is, this is an expensive process, how do you protect yourself? If it doesn't
And then
work
you get
out?
to the end and there's no transaction.
They don't
Right,
buy.
right, and they don't buy. Failing to address issues is one of those things. Like if you don't have a really good accountant, if you don't have a CFO, and you're a big enough company and you can't generate financial reports internally, and you have to hire someone to do all of that work for you, then that's gonna be an expense. And you want to drop as much money to the bottom line, but you don't wanna pay someone to come in and be a CFO to generate all that information. Part of my job is to help put together all of that due diligence information as much as you can that is relevant going to be to a buyer. And we'll do a lot of that work up front. And then a lot of the stuff you're just going to have to kind of put together. But that's part of what my personal process is what can we anticipate that a buyer is going to want to need to see in just going through their initial analysis, but then going through due diligence and anticipating what they're maybe going to need to see. And either hiring someone on a fractional basis to do some of that work. But I don't think that, I have never seen a bill be that high and not get to a finish line unless something went sideways at the last hour. But generally, most of the heavy lifting by CPAs and attorneys is going to be during the purchase and sale agreement that's being drafted. My practice is, this is not boilerplate. It's all drafted by an attorney, and most of my heavy lifting. So there's no expense to me until I sell the business. And so we're trying to get 80% down that road and in anticipation. Did you have a specific situation?
Well, yeah, I don't want to take up all the time, but it's kind of like buying a house. I mean, you put down 10%, and then I decide not to buy the house, I lose my 10% in theory. I mean, you go back and, so there are no arrangements like that in buying a company, whereas the purchasing company gives you X amount of
Earnest money and the
if they
non-refundable.
don't honor the sale.
Right. Yeah, there's no non-refundable earnest money in a business sale, and that's why you just have to be, again, extremely prepared. And you have to anticipate all of the buyer's questions, have those answers immediately, and maybe we're going to need to do a little bit of work up front. But real quick, Joe, this was last minute. This just came to me. I will, for anyone in this room 10th person who emails me, I will provide what I generally charge, $5,000 business valuation for your company. And you have to be profitable, okay? You have to, generally, to value to you for my valuation report is revenues maybe north of $2 million. I represent companies, revenues $2 million, $3 million, up to about $25 million is my sweet spot. We didn't get into that. It's important for you to know who you're working with and if that is the right broker for your size of business. That's the kind of businesses that I represent, but the 10th person to email me, and if there aren't 10, I'll pick the last one. But I'm going to give away a business valuation to a business owner in this room if you meet some of that criteria. and I'll do that valuation for you for free, which is usually about $5,000. So thank you.
That's nice. Thanks, Taralee.